Maverick traders, and welcome back to your currency midweek for August 17th. Corey here with you as per usual. Let's start with the reminder that everything we trade and do is risky. Of course, we need to understand risk, reward, probability, and that's where the education comes in. So make sure that you follow your trading plan. Let's get to it. As always, we're going to start with the equities and kind of work our way into FX. And starting on equities, I think that there is an important turning point likely to happen in the very near future. So I think the top is essentially in for stocks. And, I mean, it sounds kind of dumb to say it out loud to think that you can it's not that you can predict the future, but it's more about just knowing how risk and reward and these things ebb and flow. And I always say it's a lot easier to know what is going to happen than when it's going to happen. So the idea is not that I've pinpointed the top to the absolute day and, I can predict the future. No, but I kind of feel confident that I can figure out in most cases, not all cases, in most cases, kind of how some of these things will play out. And the nice thing about trading is I have no opinion on a lot of different things. If I pull up a lot of things, I'd say, well, I have no idea where that's going. It looks a little bearish, but I have no idea. No idea, no idea. But sometimes the pieces kind of come together. The puzzle is set, and you say, okay, we've got the technicals, the fundamentals, the sentiment, all these things kind of setting up. And I think we're at that point where we're basically near the absolute peak in equities, that we will start to work our way lower in the coming weeks ahead and meaningfully lower potentially. So we'll see about that. US dollar, we've traded the US dollar really well. I feel like I've had the pulse on the US dollar right here, right now. US dollar and currencies, I'm not sure that I really have a strong opinion on much of anything. I've looked at a few different things lately. The last couple of weeks, we've been looking at some yen trades and playing the yen for a little bit of upside. I still think that probably has merit, but I don't know how much or, against what currency. Again, I am not shy to put out my opinion by any means, but I'm also readily going to admit when I just don't have an opinion, right? When I just don't see a certain market or a certain opportunity as having much of anything that's all that exciting. And that's kind of where we're at in FX is, well, I just don't know that there's anything that really excites me too much right here, right now. Commodities have rolled over. I still think the energy play, like nat gas, is hitting new highs, new multi-year highs. Oil's been a little bit weaker, no doubt, but I still think oil's going to stay relatively well bid. So when you look at commodities, I've said this for some time, I separate energy from the other commodities to a large extent. I think energy stays relatively well bid. I think it went through its crisis that knocked out a lot of oil companies, suppliers, et cetera, as oil traded down and traded negative in oil prices during COVID and just stayed down in the 30s and 40s. It just wiped out a lot of the basic components of the market. A lot of different projects were shut down and people got out of that line of work and so forth. And so it takes a while to kind of get back to normal, and we're in that growth phase. My opinion is that in the coming years ahead, we're probably much more likely. I don't know that we're going back to $40 and $50 per barrel of oil. I think we're more on a path towards 140, 150 per barrel of oil. So we'll see about that. Economic reports, CAD, CPI came in as expected at 0.1, and then the RBNZ raised by 50 basis points. That's what they were expected to raise, to go from 2.5 to 3% on their rates. We actually traded that together last night. So those of you that tuned in, we had a nice little trade there. It didn't progress where I think you would have made money on all of the trade, but certainly hit our halfway mark. We said we'd take profits on half at about well, we targeted a move down that was about 70 pips, but I think certainly anyone could have made 50 or 60 or maybe the full 70 pips on half of the position. I think the other half would have stopped out, but we can look at that currency together as well. As we look at weekly performance, kind of quiet. The S&P equities just going sideways. Crypto down 4, gold down 2, oil down 4. And you're seeing in terms of weekly performance, everything has a minus sign. So there's not, everything kind of has been moving up together to a certain extent for a few weeks. Now everything's kind of taking a breather here together as well. If we take a closer look at the S&P 500, here is my take on it. So you can see that we've come up underneath that 200 period moving average in the S&P. If you look at this a few different ways, in the short term, clearly we're in an uptrend. That's not debatable, right? We're up above the 20, we're up above the 50, and just keep it simple. We've been trending higher in the short term. But people like to put definitions on things, and so people will say, well, are we in a bull market or are we in a bear market? Which one is it? And my opinion is we're still in this market, even though we're in a short-term uptrend. And that perfectly makes sense, just as every downtrend for the last few years in the market did not mean that we were in a bear market, right? Every time the market stumbled for a couple of weeks, you didn't go, oh, now we're in a bear market. You said, no, we're in a bull market. It's had a rough couple of weeks. We've had a good couple of weeks. That doesn't mean we're in a bull market. So everybody's so kind of fixated on this. But here's kind of the point. If we look at a long-term chart of the S&P 500, this is a 50-week moving average. So now we're on a weekly chart, not a daily chart. Each candle represents a full week's worth of trading. And if we were to just kind of simplify, for the last 15 years or something since the COVID crisis, I guess that's, or not COVID, the great financial crisis of '08, 13, 14 years ago. For the most part, the S&P has spent most of its time above this 50-week moving average. We have been above it by far the majority of the time. Are there a couple of little bear markets that occurred? Yes, you can see one back here that we were coming out of. This was 2020. And if you look back, it fell a little further back in March and so forth. But the point is that in 2020, we went into a bear market. The markets fell, 40-ish% off of their highs. It certainly was a bear market. We were below that 50-week moving average for a few months, and we crossed back above it in the middle of 2020, and we've been in a bull market since, until now. The start of this year changed things. You broke and closed below this 50-week moving average for the first time in years right there early this year. And that was a game changer. And notice that the market still bounces, still has corrections back up, and we're in a deeper one. But that doesn't mean we're in a bull market. If we look at this in proper context, on this long-term chart, the 50-week moving average is now rolling over. We're still below it. The 20-week moving average is below that. These are long-term charts, but that's what they're designed to do, is basically give you the big picture. So if you want to say, are we in a bull or bear market, you got to look at a big picture chart. And all of this was a bull market quite clearly, quite obviously for a few years there. We've moved into a bear market, and it's probably going to be a bear market for another, I don't know how long, maybe another year, maybe 2 years, I don't know. We'll figure it out as we go, but that's the way I see it. And the way that I see it is we've been on a tremendous run. This is a fantastic rally that's taken us higher for the past 8 to 10 weeks or so. And what do we do from here? We likely back and fill. In the coming weeks and months ahead, I just don't think we're out of the woods. I think we will very likely continue to see some downside pressure. Now, long-term investors, this doesn't mean they have to go completely to cash. I still own some stock. I don't go all in and all out, but at the margins, if I feel like I want to, free up some capital and so forth, this would be a nice area to do that, in my opinion. Now, as we look at the FX markets for this week, the US dollar bouncing back, Euro, Pound, and CAD a little bit stronger. Aussie and Kiwi quite clearly, the underperformers, the weakest areas of the market here, Aussie and Kiwi. As we look at crypto, everything in the red, pardon me, led by Solana, down 7% on the week, but pretty much everything down across the board. And that's what you'll find in crypto is there can always be one crypto that kind of outperforms, underperforms, but they tend to trade together as a group. So they tend to all go up together or all go down together, kind of in unison to a certain extent. Let's go take a look at a few different things together. Now, if we look at this in context again, kind of looking at these charts and the trend and the momentum, I find myself in kind of a zero outlook because the short-term trend is higher, but I think we're at like the worst spot for the markets. That doesn't mean that we have to go down immediately, though. It's like I said before, look, I can do certain things and I can't do others. I cannot predict things perfectly. Timing of things is the hardest part. And so the idea that I can kind of look at a bull market or bear market and pick these tops and bottoms perfectly is just asking too much. But can I get the zones right? Do I think that this is the topping out zone? This is the area where we will fail and start to back and fill. That's how I see it, right? That's what I'm looking at is I can predict the zones and the general outlook pretty well, but I need to be honest with myself in terms of the timing. And the timing on it, I'm not going to be perfectly precise with all of my timing. So let's look at a few other things here. If we look at international markets, we've had a nice rebound, brings us back to this level. I said this last week, and I still agree with the opinion that I think international markets should outperform U.S. markets. The problem is that they'll often move together as well. So can we go to new highs, or is it just kind of outperforming a bit where we push a little higher in international markets, even as the S&P and some of the U.S. markets struggle? I think there could be that type of divergence where it outperforms, but it probably isn't just zooming massively higher. The crypto space, if we look at this chart, which combines all the crypto together, we're in a tight consolidative mode. We fell dramatically, we bounced back a bit, and now we're just in this consolidation. There is the possibility for a big breakout. My guess is that it would be on the downside, as we've talked about before, that I think this is, in crypto, also a correction and kind of a bounce back, but that will at least give one more kind of spike to the downside. Let's look at the calendar here. So tonight we get employment data out of Australia. Tomorrow we get Philly Fed here in the U.S. Esther George speaks of Fed members, and then we get some retail sales in the UK and in Canada on Friday. Nothing too significant. I think Aussie could move a little bit on the employment data tonight, but not anything really that's expected to be a major market mover. Now, let's take a look at your ideas. If anyone has any currency pairs, anything that they want to look at specifically, please feel free to fire away. I'm going to come over and let's look at a few charts together. Yesterday we talked about some of these Kiwi charts, and the daily charts on a couple of those are kind of interesting. In the Kiwi, you can kind of see this trend that had been down, 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 and we tried to reverse here. We're actually at the spot where the rubber meets the road in terms of Kiwi USD. if it can't hold right here at these levels, well, the downtrend persists and so forth. We traded Euro Kiwi, and it actually worked out pretty nicely. It doesn't kind of look that way on this chart, but if I come in to, well, the 4 hour, let's use that one. We shorted this, and I don't know exactly the exact numbers right offhand. I think it was actually 160.19 or something like that, 160.20. And we discussed that you could look at this as your ideal target, which would be over 100 pips lower, but to take profits on half down at this level, down at this prior low. So that's all we got out of it. It traded in our favor, worked really nicely, traded right down to that level where you would have, could have, should have taken off half, moved your stop loss down, and so on. So I think the trade was a good one, but look at the reversal. It did not go down to those lows. Instead, it reversed that trend to the upside. So, we were in kind of the wrong trade and made money, if you think of it that way. The overall outlook, and how this thing could behave, it moved in our favor in the short run where we were able to lock in profits and move the stop to break even and so on, but it really didn't make the big move. So in terms of the trade and whatnot, we sort of were in the wrong trade but got the right result, I guess you'd say, because the overall trade blasted that way. Had we got a big blasting move this way, it would have been a really nice trade. As it was, you probably locked in half of the profit and got stopped out in the other half at break even or so. So let's look at a few of these others. Pound versus Kiwi. Kiwi's interesting, in terms of its weakness. Aussie also very weak. Pound Kiwi, let's work our way in. So here's the daily. And again, this is where all of these charts are kind of reversing and not holding where they should, would, could. Here's pound Kiwi. And this is kind of that key level where it broke down from. It theoretically should fail right there, and it's not, right? It's breaking back up, breaking back into this range. That makes it difficult to trade. A lot of false entries. I certainly believe that from false moves come fast moves, so I'm not surprised that this is, as it's kind of leaving this as a false breakdown, it's moving sharply higher. Kiwi is seeing some increased selling pressure and whatnot. You'll see that across all of those pairs. If you were to look at Kiwi, we have a few different requests. Kiwi versus the US dollar. You're going to see the same thing, just that Kiwi weakness, right? That is a little more than it theoretically should, right? Here's the breakout in Kiwi versus the US dollar. Here's where it should have, would have, could have bounced, and it's not doing that. Now you're at sort of the last line of defense. This is the 50-period moving average, and if we can't hold here, the entire trend, the short-term uptrend has failed and so forth, then it kind of seems that that's what it's going to do. So, the Kiwi added weakness, Australian dollar with some extra weakness, not looking great. Yeah, I could see trading Kiwi versus CAD or something like that, where you say, if Kiwi's going to be weak, maybe we pair it against CAD, which has been stronger. And I kind of prefer the CAD from the standpoint of increasing rate hikes, kind of surprising the markets with aggressive rate hikes that weren't priced in, stronger energy markets and such. Now they have potentially some real estate problems and real estate bubbles and things in Canada. It's not, when you're comparing these currencies, in a lot of ways, it's finding the best house in a bad neighborhood, so to speak. They're all a bit rough, and we're trying to find, maybe the one that's not quite as ugly as the rest, to use a housing analogy, best house in a bad neighborhood, so to speak. When making a news event trade like last night, how do you determine the size of the pips you choose for the trade? So, generally speaking, I would just say for me, usually trading on an event like that that's really short term, depends on the pair, and the pairing itself will often kind of show you how many pips is reasonable. If you kind of look at, ATR, for example, average true range, how much it moves on average, or the size of these candles and so forth, it'll give you a sense of how far away to have your stop loss. So if we were looking at something like Kiwi CAD, I mean, realistically, if you were shorting in here at 80, 97 or something like that, kind of where it's at right here, you could probably put your stop, somewhere up above this level at 81.70 or something along those lines. It would kind of show you, and that's about 70 pips or so. If we were to add an ATR, well, the ATR's on right here. Look at it down here at the bottom. It's at about 70 pips. See, so we eyeballed it before I even noticed the ATR down here. We kind of eyeballed that. Well, you probably use about a 70 pip stop. If you look at the ATR, it's in that 70 pip range. That's its average true range. Now, if I change the pairing, that's going to go down significantly. A lot of pairs, your stop losses are going to be more like 30 pips, 40 pips. And again, it depends on the pairing. Like if I go to Aussie US dollar, now that thing is, this is a daily chart. So I guess I'm showing examples on the daily chart. That's a mistake, where I should probably be showing this more on like a 4-hour or an hourly or something. And so now it's a little bit more reasonable in terms of, okay, if we tried to short this here, put a stop up here, it's not going to be that, 70 pips. It's going to be, hey, the 4-hour movement in this thing is only 23 pips per 4 hours. You could probably have a 30 pip stop, something like that. So I shouldn't be on the daily when I'm showing that, because we're using the daily, but we're trading more off of a short term. But you would use the candles, you would use the setup, and you'd use that ATR. Something like Aussie USD, probably going to have a 30 pip stop loss. If I go to pound CAD, or mix it up a little bit, here you're probably going to have a 40, 45 pip stop loss. Euro USD, which is very popular, again, probably 30, 35 pips. You'll be at the ATR a little higher than the ATR. A lot of traders will use what they call a volatility stop, and you can multiply the ATR times 1.5, and that'll tell you, so if the ATR was 30, well, what's 1.5 of that? It's 45. It's 30 plus, 1.5 times 30 is 45 pips. So if you use that 1.5 times the ATR, if this ATR right now is at 27, we'd go 0.27 times 1.5, and it would probably tell us to put our stop loss about 40-ish pips away or whatever it is. So something like that. Good stuff. Yeah, and if you're using the hourly chart, then your stop loss can be even tighter. The reason that Euro Kiwi was going to be more aggressive, well, it's one of those that trades a lot of pips. Look at it on the 4-hour chart. Its ATR is 55. Notice that our stop loss last night started out, what was it, I think it was about 55 pips, if I remember right. Something like that is where we kind of started. We ended up locking in profits of about, that's about 70 pips right there. So we had a reasonable stop that put us up here above this level and such, utilizing the currency pair's personality. It wouldn't have made sense to put on a stop loss that was like 20 pips away in all likelihood, because this currency pair just moves too much for that. Each currency pair has its own personality, And that's what the ATR will show, is how much volatility does this pairing have. Let's see here. Did we overlook any others? Aussie USD we had a request for. So let's take a look at that one as well. And Aussie USD, so let's work our way in. Here's the daily chart. And again, not holding where it should be, right? The 4 hour, you can see the trend moving lower. I think this is setting up for more bearishness, probably. You know, you can start to see the failure, and then it probably bounces, and that's probably a short. So if this holds at support and gives kind of a weak bounce up into this area, it would be one of my favorite short setups. It would be an inverse cup and handle. It would be a bearish, you know, you could call it a descending triangle, whatever you want. The point being, we respond to key support, we have a weak bounce, and then you often go plunging below. So to short it right here in this bounce is just such a good spot, because if I'm wrong, I lose a few pips. If I'm right, I get that big flush and I can take profits as it makes that big flush to the downside. So it's going to take a little patience. It's not set up right here, right now. But on a weak bounce, I think Aussie USD could be a short setup for sure. Shorting the yen, I don't want to be short the yen. I know some things are rallying versus the yen today. You know, probably everything but Aussie and Kiwi are rallying a bit. But I would, you know, if I'm doing anything with the yen itself, I'm probably going long the yen. I know that a lot of these charts don't, you know, they kind of had, let's go to the daily. So let's go pound yen. Okay, it's been working, meaning pound has been trending lower versus the yen, except for the last 2 days. Well, where do we go from here? I still think there's a greater chance it leaves on the downside. So maybe this is just a descending triangle or what have you, but it is bouncing right here. That's what I'm saying. It's not necessarily set up for a lot of these to be a short right here, right now against the yen, but I still would err on that side of things. Now, if you go to Aussie or Kiwi versus the yen, those are breaking down a little bit more over the past couple of days, so maybe you can start to look at those, you know, as potential trades. Like if I look at Kiwi Yen, you actually have a setup here. If you trade, we broke the 50 period moving average, that's this black line, and then we went up underneath it, kind of failed there, and we're starting to roll over. This should continue to trend lower. So I would still err on that side of things. I just switched it to Aussie Yen and don't even need to change my drawings because it's pretty much the identical chart. Broke the 50 period moving average, came up, kind of failing at that level, and should continue to trade lower. So that's still where I would be looking at on those yen pairs, is I would much rather short things against the yen. I still think the yen is going to have a little bit more strength here than anything else for a while. That's my take on it, my opinion on it, which really works well in a risk-off environment, which I don't think is too far off. I like shorting equities. I like looking at bearish trades in equities, and I like playing more defensively in FX, which correlates, right? If equities fall sharply, usually the Japanese yen will do well, and that means that all these other currencies should fall against it. The Aussie yen would be a nice short. The Kiwi yen would be a nice short because you'll get that added strength out of the yen from a defensive standpoint. So to look at the rest of this week and into the first part of next week, we've got an ATR class that we just talked about. We just talked about the ATR, you know, how it's the personality and such. Well, we're going to have a recording. I'm not sure who's doing that one, but that'll be a great class. We've got a recap recording that'll come out. And then our currency room, as always, will be sent out over this weekend. Then next week, we get into some personality tests and some things of that sort. So plenty to keep you busy educationally, classes coming out. Hope you all enjoyed it. Have a great rest of your day, and we'll see you next week. Same time, same place. Goodbye, everyone.